share with you. I'm going to do a recording on topic chapter 13, statement of cash flows. Yeah, so we'll go through this topic, cash flows. They could be the last topic for the semester for financial accounting. Okay, so as we have known before that we have few statements that we have covered. Number one, we have done our statement of financial position, where you see what is under financial position is shows your asset, liabilities, and honest equity. Then we have done your statement of income, where it shows your revenue and your expenses. And from there, you get your profit. And then we have not gone very detailed on the statement of retained earnings. So statement of retained earnings shows you the beginning retained earnings plus any profit made during the year minus your dividends. Then you know how much is your retained earning at the end of the year, for example, yeah, for the period. So whatever you have at the closing, then you bring that amount to your financial position. So when we come to statement of cash flows, right, as the name shows, that is actually the statement that shows the movement, yeah, the flows of your cash. So your cash, as seen your financial position as your current asset. So what you have in the financial position is the balance of cash at the end of the period, right? But you, as an investor, as a creditor, you also want to know how the company actually have made use of the cash that they have, right? You want to see what are the cash use, for example, cash inflows and how is the cash outflows of the company. So you want to look into all these because it may affect your decision making, yeah, as an investor or as a creditor, and also the management one also want to know how the company has actually managed their cash, right? Okay, so the cash flow statement, all right, provides information about the cash receipts and cash payment, right, of a business during the accounting period. So cash receipt is what we call cash inflows, yeah, and any cash payment, cash made by the company to others, is the cash outflows. So you're going to see the difference between cash inflows and the cash outflows, right? So you want to, at the end of the day, you want to see what is the net changes, right? Is the cash inflows is more than cash outflows. Of course, for company, of course, cash inflows is more favorable as compared to cash outflows. So why do you have to look into the statement of cash flow? Because by looking at the statement, all right, for an investor, for example, all right, you may be able to see or to see how the company actually generate positive cash flows, right? So positive cash flow means that the cash inflows is more than the cash outflow. So because of that, you have a positive cash flows. And then the ability of the company to meet its obligation, right? It means that would the company be able to pay for their creditors for their short-term obligations? Yeah, would the company be able to pay dividends? Because of course, as an investor, I want to be paid dividends. All right, even though again, dividend is not an obligation to the company, but in order to keep the shareholders happy, normally company will pay dividends to their shareholders or to the investor. So as an investor, I want to know if the company have sufficient cash to pay my dividends, right? And then you'll see that net income shows you revenue and expenses. But if the company is making a profit during the year, all right, not necessarily the company has a lot of cash. Because why? We're talking about income and revenue is based on the accrual basis, right? You may have a lot of income or revenue, but you have not received the cash, right? Or you may have incurred a lot of expenses, but you have not paid for it. So that would not tell you, right, that even the company is making a lot of profit, it doesn't mean that the company has a lot of cash. All right. So how you know that? You have to refer to the statement of cash flow, right? And it also indicate whether the company need external financing, right? And then the statement will also shows you the investing and the financing transaction for the period. Okay, how do we know from the cash flows? Because the cash flow is divided into three types of operation activities. Number one is what we call cash flows from operating activities, right? Then we have cash flows from investing activities and cash flows from financing activities, right? So you will have to show during the year, all right, when talking about operating activities, what is operating? All right, so how will you know what do you mean by operating activities? What we say is an investing activities, which kind of activities fall into investing. And similarly, when talk about financing, what do you mean by financing? Yeah, so you'll see that at the end of the day, right, you'll see that you have a net increase in cash. So you look at here, because from this operating, all right, you'll see that they show you an inflows and outflows. All right, so inflows mean cash comes into the company. All right, so you receive the income, the cash. Cash outflows mean you pay out. All right, so you will see that for each activity you have a net cash provided. Yeah, so you'll see here that um, let me try. Okay, so you see that here you have a net cash. Yeah, so it means that what is the net inflow and outflow from activities? In this case, we are talking about operating activities. Similarly, for investing activity, you're going to look at the net. So whether it's a positive or it's negative cash flows, yeah, from each of these activity. So during the year, so this refers to the changes of cash. So whether you have a positive cash inflows or a negative cash during the year, right? But remember that at the beginning of the year, you already have the opening balance of your cash account. So opening balance in this case is the beginning, all right? And then you look at the changes made during the year, whether is it a positive or negative, yeah? So that will give you the final. So this is the amount of your cash at the end of the period. All right. So it means that beginning of the year you have certain amount of money, and during the year there's a cash inflow and cash outflow. So what's the net? All right, the net increase or decrease in cash. So that will tell you how much is the cash that you have at the end of the basis period. So this is the one that goes into your SOP, right? Financial position. This is the amount that goes into your cash in your financial position. Yeah, so that's how it goes lah. Yeah, so whatever you have cash in your financial position, amount of cash that you have is actually comes from the cash flow. It should be translated into the cash flow, right? So as I mentioned earlier, we divided the cash flows into three activities: operating, investing, and financing. All right, so what is the operating activities? All right, we talk about operating. All right, if you're talking about your business, right, the activity of the business is mainly operating activities. Right, for example, you're talking about a retailing business. All right, so the retailing business, the main activities is buying and selling of products, all right, or inventories. So the cash receipt from the operating activities, in this case, we are referring to the cash receipt, right? So cash inflow comes from who? From your customer or from sales of your goods and services. So whenever you sell to your customer or whatever you receive from your accounts receivable, so that will be a cash receipts or cash inflows. All right, so these fall under operating activities, right? But also, if you have any interest income, so you're talking about receipt, it has to be interest income, or any dividend. In this case, you're talking about dividend received, so that's why it's cash receipt. Yeah, so in this case, when you have investment in other company, so other company pays you dividend, so that dividend received is actually part of your operating activities. All right, and you may also have other receipt from operation, for example, proceed from settlement of litigation. So it means that, for example, a company was the company involved in any law, legal issues, for example, and if there is any compensation paid to the company because of that litigation issues, all right, then the money receipt will be parked under operating activities. So when talk about operating activities, it always refers to your customers and your interest income, your dividend income, as well as other proceeds that you receive. Yeah. But talking about cash payment is the cash outflows. So this one talk about whenever there's a payment to your suppliers, all right, or when we're talking about payment to it could be payment suppliers, accounts payables, yeah. And then if you have to pay interest, right, when you have to pay interest, for example, you take up loan from the banks, yeah, and on the bank loan you had to pay interest on that. So the interest portion is part of the operating activities. So whenever you make payment of your loan, all right, there are two parts of the payment. One is the interest portion, the other one is the principal portion, right? For example, let's say that every month you have to pay to the bank 10,100, right? 10,100. So whereby 10,000 is your principal portion and 100 is your interest portion. So the payment of this installment payment, all right, the payment of your loan to the bank, all right, because there are two parts, the interest and the principal. The interest portion, the 100, must comes under your operating activities. The payment of 10,000 ringgit goes under, later you see that it's under financing activities. Yeah. So that is on the payment of interest. Similarly, if you have to pay for your income tax, all right, it falls under operating activities, and other expenditure. For example, you have to pay for your, in this case, you're talking about litigation. Sometimes you do receive payment, compensation, but other times you have to pay, right? For example, your customer may sue you for some fraud, or for example, right? So you have to pay them. So in that case, that payment falls under operating activities. So the cash receipts is your inflows and cash payment is your outflows. Okay, what about your investing activities, right? So investing activity, again, you do have the cash flows, the cash receipts, cash inflows, and you also have the cash payment, which is your outflows. All right, what is a receipt? Any cash proceeds, so amount that you receive from selling of investment and plant and intangible asset. Remember, investment, you may have your investment in other companies. Right, so you have bought shares in other company. You may have purchased any marketable securities. All right. So in that case, if you dispose of those shares, all right, in other company, so that disposal, all right, the cash proceed that you receive from the disposal of the shares comes here. All right. Similarly, if you dispose of your plant, remember last time we have a plant and intangible asset. So when you acquire the plant and then now you dispose of the plant. So when you dispose of your plant and intangible assets, you will get money on the disposal. So the amount that you receive cash inflows, and that cash receipt will goes under investing activities, right? And similarly, just now we say that cash proceed from collecting principal amount on loan. So in this case, you say about your money, you receive money. In other words, you give loan to other person, and that other person pays you back. All right. So in this case, if they pay you back, you are actually the company that receive the money. So when you receive the money, the amount of principal will go under investing. All right. The interest that you receive goes under operating. Yeah. And then on the other side, on the cash payment, right, when you acquire investment and plant, so when you purchase your investment, when you purchase your plant and intangible assets, the cash that you pay for it as a cash outflows, and that fall under investing activities. Similarly, for example, amounts advanced to borrowers. So if you pay out cash to your borrowers, you lend money to others, so that money is a cash outflow, and that goes under investing activities, right? And remember that just now example whereby you have to pay back the bank, all right, pay back the loan, all right? So the principal amount of the loan, when you make payment, all right, the principal amount goes under investing activities. Oh, salah, that is financing. Sorry, that is financing. Okay, look at the financing activities. Cash receipt, all right, from both short-term and long-term borrowing. So it means that if you borrow money from outside, so cash comes into the company, you receive cash. So any proceed from both short-term and long-term will go under financing. And then cash receipt from owner, for example, there's an investment by the owners, all right? Investor put money into the company, or when the company issues shares, right? So whatever that you receive is cash receipt under financing. So remember that financing is talking about money borrowed from the it could be from outsider, it could be from the bank, right? Or maybe the money invested by the shareholders. So because all this money is used to finance the company. Cash payment, for example, repayment of amounts borrowed. Remember just now the principal amount that you borrow, right? The principal portion goes fall under financing. The interest portion falls under operating. And then you also have payment to owner. For example, when you make payment to your owners or to your investor, to your shareholders in the form of dividends, so that amount fall under financing activities. Okay. So when talking about cash and cash equivalent, right, we not only talk about cash in the form of currency, but you also have cash equivalents. Yeah. So this cash equivalents normally is not money itself, but for example, you're talking about the check. All right, because check is not, you cannot buy something using the check, right? Because yeah, you can give them check, but whatever that you pay by the check, the seller will have to bring the check to the bank, then only they can get the money. All right, so that's why it says that cash equivalence. So it's very liquid, right? But it's not as liquid as the cash itself, lah. You still have to bring that to the bank in order to exchange the check for the cash. Yeah, it's convertible. Okay. So this is an example. Company name is statement of cash flow period covered. So this is how you represent the statement of cash flow. You have the company name and then statement of cash flow, and then the period, for example, for the period ended 31st December, for example. Yeah. So this is cash flow from operating activities. All right. So there are two methods for you to compute or to prepare the cash flows from your operating activities. Right. Number one, there's a what we call direct method. Number two is the indirect method. Right. This is only for operating activities. But for financing activities and for your investing activities, is the same, right? There's no different. There's no such thing as a direct method and indirect method. Is the same for both financing and investing. Only for operating activities, there are two methods. One is the direct method. The other one is the indirect method. All right. For the purpose of this course, all right, I will only choose one method. I will go into the indirect method. All right. We are going to prepare your operating activities using indirect method. So that's the second one, lah. Right. So we are going to use the indirect method. Okay. So how are we going to prepare your cash flow from operating activities using indirect method? So you are provided. So in order for you to do that, all right, it says that first you have to understand that you are going to reconcile your net income with net cash flow. So what it means is that in order for you to prepare your cash flow, you must start with your net income. So where will you get your net income? Your net income comes from your statement of your income, lah, right? So means that your profit and loss account. So from your revenue minus expenses, you have your net income or your profit. Yeah, so normally we call it as a net income, lah. All right. So starting from net income, right? What you're going to do is that net income, you're going to do adjustment. All right. We call it as a reconciling items. So what are these reconciling items? Number one is that we call non-cash expenses. And then we also have the timing differences, right? Non-cash expenses. In your expenses, you will see that there are some expenses that you have to pay, and the other expenses that it's an expense, but you don't have to pay for it, right? This is example. For example, we have the depreciation. All right, we have a depreciation expense in your income statement, but you know that the depreciation is just an allocation of costs. You don't have to pay for your depreciation, but you show that as an expense in order to match against the depreciation value of the asset, all right, because the asset depreciate over time, so you have to match the cost of the depreciation, right? And then for that, all right, another example of non-cash expenses is when you have gain or loss on your disposal of your asset, right? Remember that the gain or loss, for example, you purchase a plant that costs you 10,000, right? Over time, because you provide depreciation, the net book value of the plant is now become 6,000, right? Cost is 10,000, net book value is 6,000, and upon disposal, you can actually sell the plant for a value of 7,000, let's say, right? So when you have net book value of 6, but you can sell at 7,000, then you know there's a 1,000 gain on the disposal. So gain on one of these is you don't actually receive the cash. The 1,000 is not there actually, yeah. It's just because the net book value is lower than the actual cash received. The actual cash received is actually goes into your, remember just now we have the investing activities, so it goes there. But the difference here, the 1,000 is the gain or even the loss on the disposal actually reflected as a non-cash expenses. Yeah, it could be a gain as well. Yeah. Okay. So what happened is that we always start with the net income. All right. And then you have to see, number one is that the changes. So just now you have the losses and gains. All right. So if you have losses, then you have to add back, right? And then you minus gains. So what happened here is that, all right, you start from net profit because you want to reconcile between your net income and your net cash. Remember that income not necessarily be the same as how much cash that you have, right? So that's why you have to do a reconciliation, all right? So for example, losses and gains, for example, you have to do adjustment, right? So why you losses, you add back losses, right? Remember this sign? Okay, this sign is ni. Losses ni is a plus, gain is a minus. All right. So let's see when you have losses. All right. When you have loss, is an expense. Yeah. So expense in arriving to net income, do you add or you minus expenses? You minus. All right. So it means that whatever income that you have, you will minus your losses. Yeah. So in order to adjust, because losses in this case is a non-cash item. In this case, for example, you don't see it. We see just now losses on the disposal of your asset. So you minus. So in order to adjust, all right, because non-cash, so you add back. So that's why you plus losses. But gain, if you have a gain, then you add in arriving to your net income. Yeah. For example, you have gain on disposal of his asset, you plus as part of your revenue, right? So you plus that, then you should say that, okay, you have a higher net profit because you have a gain. But in order to reconcile that, you have to take it out. So plus, how do you take it out? You minus. So that's the adjustment that I have to do, number one, all right? If there is a losses, you add back. If there is a gains, then you minus. Right? And then if there is any depreciation expense, right? If there is any amortization expense, you have to add back. Why you add back? Similarly, all right, in arriving to your net income, you have actually minus all these expenses. Okay, so all this is a non-cash expenses, you add back. Okay, and then you're going to look at the changes. Changes means that there is an increase. Is there an increase or there is a decrease? That's what we mean by changes. How you know the changes means that you're going to compare your current asset and your current liabilities. Right? You have current asset and you have current liabilities. So current asset, we put it as a CA. Right? Is this your current asset? And this one is your current liabilities. Okay, this one is your current asset. Yeah, current asset and current. So when we say that changes, we are looking at year one. All right, year one, and we are looking at year two. So So you're going to compare previous year and the current year. When we talk about current asset and current liabilities, you're going to compare previous year and the current year. Is there an increase or decrease for every item of your current asset and your current liabilities, right? So you have to look at the changes. You compare previous year and current year, increase or decrease. You understand that? All right. So you look at current asset, every item. Asset, for example, current asset is your cash, your account receivable, your inventories, your prepaid expenses. All these are your current asset. So you have to compare between the previous year and the current year. What's the movement? Is there an increase or decrease? All right. Kalau increase, then you put a note lah, it's an increase. If there is a decrease, then put a note, a decrease. Similarly, for your current liabilities, you have accounts payable, you have wages payable. Anything payable is your current liability. Yeah. So you compare between previous year and the current year. Is there an increase or decrease in terms of your current liabilities of each item? Yeah. So you're going to take note of that because this will make you are going to do some adjustment in arriving to your net cash operating activities. Right, so this is what we say that, all right, when talking about reconciling net income with net cash flow. So remember I talked about the current asset, the movement, all right, so you have to look at whether the movement in the current asset and the current liability, is it an increase or decrease? Yeah, so if an increase, then you say that is subtract, is decrease, you add. But for the current liability, if there is an increase, you plus, and if there is a decrease, you subtract. I have actually prepared another table, right, for this, where I think that it makes more sense. Where is it? Okay, this is how I see it, all right? It's the same. Can you actually look at this? Hold on, yeah, I check. Where's my okay, I'm not sure if you're actually looking at. Can you actually looking at this now? I hope so. Yeah, let me check first. Okay, hold on. I just want to make sure that you actually see what I'm showing now. All right, yes, you are. Okay, then I just have to check on that. Okay, what you see now is actually the translation of the table in your PowerPoint. All right. So you see here for direct method operating activities for the current asset and current liabilities. All right. Whenever there's a in this case current asset, if there is a increase of the current asset, you're going to minus. Right? If there is a decrease in your current asset, you're going to plus. That's what it meant. Yeah. But for current liability, if there is an increase, you plus, but there is a decrease, you minus. So normally, all right, is it the other way around? We say that if normally we say that if a current asset increases, we plus, right? Because we like we when there's an increase in your current asset, it should be a positive. But here you look at it as the other way around, right? If current asset increases, you minus. If current asset decreases, you plus. But current liability is by way, you shouldn't like it, all right? It's not a favorable increase in the current liability. But for the purpose of this direct method, all right, whenever there's an increase in your current liability, you're going to add. But if there is a decrease, then you're going to minus, all right? You may have to remember this, all right, as a tips. All right, or if you think that in your exam, if you will have to do an exam on your cash flow using direct method, first thing that I would do is that I would just draw this table again, all right, so that I remember that whenever CA and CL increase and decrease, I put the minus and plus signs. All right, so I will try to have these whenever I do cash flow method. Right, whenever I have to prepare cash flow using direct method. Okay, so that is on the, okay, now where is the, okay, so this one we are going to go back later. All right, so whenever we have the information, then you see that how we are going to apply this information. Right, so in summary, remember just now we are starting from, in this case we are, remember we are only for the operating activities, right? Starting from net income, you're going to add back your depreciation. All right, and then accounts receivable, current asset, whenever there's a decrease you add. Right, if you look at here, right, so all these, right, is your current asset. Right, so whenever there's an increase of a current asset, you're going to minus. So that's why you minus, decrease, decrease, decrease. All right, sorry, current asset here, whenever there's a decrease, you're going to add. But here is your current, in this case, this one is your current liabilities. Okay, so when there's an increase in the current liabilities, you are going to add. And then you have non-operating. So remember, you know, non-operating losses, you have to add also. So, for example, you have loss on disposal. All right, loss on disposal, so you add back. But what you minus, remember again, this one is your asset. So whenever there's an increase in your current asset, you're going to deduct. So how do you get that? Remember just now? Okay, so current asset or current asset, whenever there's a decrease, you're going to add. Whenever there's an increase, you're going to minus. But current liability, whenever an increase, you plus, but whenever there's a decrease, you minus. So that's how you apply those information and plug it into the method. Okay, so let's do an example here. Okay, so let's do an example in your, okay, actually this one is, okay, what it says here is that, okay, a worksheet for preparing a statement of cash flow. So you are given the balance sheet of the company, right? So you see from the balance sheet, you have your asset, liabilities, and your stock equities, and you are given 2 years, right? So you're given 2014 and 2015. Hold on, yeah. Okay, right. So this is why I'm saying that now you have 2014 and 2015. So you have cash is your current asset, marketable securities is also your current asset, account receivable is your current asset, inventory is your current asset. But you're talking about plant and equipment, no, this one is not your current asset. So this one will not fall under your operating expenses. Yeah, this one will not fall under operating expenses. This one is part of your investing later. Yeah. And then you say that now on the liability side, you have accounts payable, which is current liability. Accrued expense payable is your current liability. But your mortgage note payable, this one is long term, so it's not current. Bonds payable due in 2020, which is about 6 years from here, from this 2015, 5 years to go. So it's not short term, so it's not a current liability. And then you have capital stock and retained earnings. So in that case, from here, you have to identify, for example, if there is a cash, all right, in this case, cash, 2014, 50,000, and 2014, 15, 2015 is 45,000. So if I were to say that cash, all right, where do I have this? Can I have it? Sure. It's two. Okay. in this case, cash increases, right? Instead, let's say cash increases. Cash increase or decrease? Cash decreases, isn't it? Why is decrease? Because initially you have 50,000 in 2014, but the balance in 2015 is only 45,000. What happened just now? Mana tadi ya? Right? So I nak buat benda ni sebenarnya. Okay. So you see that cash, in this case, cash decreases. But what about your marketable securities? Is it increase or decrease? Marketable security initially was 40,000, but now it's 25,000. Similarly, is decreases. Common C, so this one is reduces. All right. And then you have account receivable. Initially, it was 3,020. Accounts receivable. Right. So 320, but 2050 have 330. So in this case, it's increases. Right. So kalau increase, you put arrow increase lah. Mana? Smiley lah pula. Symbol. Where do I get that from? Mana Tadi boleh search. Where is it? Sini lah. Right, I can just take this. Go down. Is it increase? Increases. Okay. Your account receivable increases. Yeah. Okay, then your inventory increase or decrease? Inventory from 240 becomes 235 is a decrease. Common C here is also a decrease. All right, so this is your movement. So then you must also know how much it reduce. Right, so kalau reduced by cash, in this case, how much it reduced? Reduced by 5,000. Okay, and then I have to bring this command X to bring it here. Okay, never mind, leave it there. Mana nak buat ni? Okay, tak apalah. Okay. Alright, similarly, you do for your accounts payable, there's a increase of 160,000. Alright, and then accrued expenses decreases by 45,000. And then there's the only two lah, current liability that you have. Okay, so what happened is that this one is increase, command C, command V, and then this one is a decrease, command C, command V. Alright, so this one is your accounts payable, and then this one is your accrued expenses. Okay, so what happened here is that, okay, remember that when a cash, okay, then you go back to this, yeah. So direct method, if there is a current asset, if there is an increase, you minus, decrease, you plus. So what happened is that cash, how much is it? Is a decrease by 5,000. So remember, current asset decrease, you add, isn't it? Salah. Current asset decrease, you minus. This one. Current asset decreases, you add 5 plus 5,000. Okay. Marketable securities by how much? 40 to 25. Now it decreased by 25,000. So you plus 25. 15,000. Okay, so what happened is that 40 to 25 is 15,000 is a decrease. But because this is a current asset, all right, whenever there's a decrease, you plus. But whenever there's an increase, for example, here, increase of 10,000, but because a current asset increase, you minus 10,000, like that. Okay, and then inventory decreases, so you plus again. Inventory 240, 235, so you add 5,000. 240 different is 5,000. Okay, what about your account payable? Account payable increases by 10,000, so account payable increase you. So account payable increase plus or minus current liability. Whenever there's an increase, you plus. Okay, so how much you plus? You plus 10,000. But your accrued expenses, you reduce by 15,000. Bila reduce, you, what do? Current liability, reduce, you minus. Right, minus 15,000. So whenever you have this, all right, so normally when you minus, you're going to show that in a form of bracket. Right, so that's how you do it. So what you want actually is the net impact, all right, later. But then you have other information. It says that the net income for the year amounted to 50,000. Cash dividend of 140 were declared and paid. So based on this information, you say that let's start with your net profit. How much is your net profit? 250,000. Okay, and then you say that net income. So here, let's do it nearby. Command X, we put it here. Command V, and then other information you have. So let's move this. Command X, let's do it here. Command V. Okay, what else do we have? We have a dividend. So whenever cash dividend is paid, all right, is under operating expenses. But issue here is that when dividend is paid, is it plus or minus? Of course, when it is a cash outflow, isn't it? When you pay your dividend, then it's a cash outflow, so you're going to minus. Cash outflow, you have to pay 140,000, so minus. Note number 2, auto only non-cash expense for depreciation. Remember, you have a depreciation. So what should you do with your depreciation? Is a non-cash, you always add back. So how much you add back? 60,000. Why you add back? Again, I say that in arriving to your net income, you have minus your depreciation. So in order to reconcile that non-cash expenses, that's why you have to add back. All right, so this one is your add back. This one is a minus. All right, and then you have marketable security costing 15,000 was sold for 35 cash, resulting in a 20,000 non-operating gain. So here, what you have under operating, remember you have gain or loss. So whenever you have gain on disposal of securities, so when I have a gain, all right, you're going to minus. Why gain is minus? Because remember, gain is again a non-cash, so you have to reconcile. In arriving to net income, you added gain on your disposal, right? But in order to adjust, you have to reconcile. That's why you minus. You take out that non-cash and the gain, you minus. How much is it? Non-operating gain is 20,000, right? And then note number 3, note number 4, it says that the company purchased plant asset for 100,000, making a 30,000 cash down payment, issuing a 70,000 mortgage not payable for the balance of the purchase price. So, but this one is not part of your operating. When you purchase plant, that will be part of your investing. All right, you are going to put that under investing activities. But the cash payment will be cash outflow under investing 30,000. But the 70,000 is a liability, a mortgage not payable, means that it's a long-term mortgage lah. All right, you only will pay the mortgage over the later. All right, so that's the information that you have. So from here, All right, now you can compute how much is your net cash from, in this case, what we call operating activities. So this is what we want to know, right? So you compute here, then you should get, how much is it? Total here is 160,000. Correct or wrong? Let's see the answer here. Statement of cash flow. All right, we got it wrong. You say that 280,000. Where we did wrong? Okay, let's compare from an X. Let's be sure where we did wrong. We started with a cash. We started with net profit of 250, and then okay, this one we did correct. And then you add back your depreciation. What's your depreciation? Yes, we add back. And then inventory decrease 5,000. Yes, inventory. What's your inventory? Yes, we add plus. And then accounts payable 10,000. Yes, accounts payable 10,000 is correct. And then you account receivable minus 10,000, correct. Accrued expense minus 15,000. Where's accrued expense? Minus is correct. And then gain on sale of securities 20,000. We have it. Oh, now I know. Where is this? Dividend paid. Why should I have dividend paid here? So it should not be here. So this is the wrong. Right? We are not supposed to have your dividend here. So if I were to take out the dividend, I have 300,000. Where else? Where's my cash? Cash? Oh, we don't have to put cash here because cash, we're preparing cash, so we don't have to show cash. What about securities here? Marketable securities. Marketable securities is 15,000. Where's the marketable securities? It's your current asset, isn't it? Net cash, or we are not getting that because here is the issue here, right? The marketable securities. Let me check further. Proceed from sale of security, cash paid, dividend paid. Dividend is part of your financing, yeah. And the retirement of bonds payable, the balance just now. Cash of plant, you pay out for your plant, that will be a part of your investing. But where is your marketable securities? Marketable securities here, marketable security is not. It should be part of your current asset, but why is it not shown here? Okay, so when you don't have it here, if I were to delete that, I should get 280. But I think that marketable security should be part of your current asset, right? So let's check that further. It's not here. We only have inventory and accounts payable in accounts receivable. Okay. Proceed from sale of securities 35,000. So this one is, remember just now you sell your security, cost you 15,000, but the proceeds is 35,000. That 35,000 is the cash receipt. So that goes into your investing. So cash receipt of 35,000. Proceed, yeah. 35,000 is the cash receipt, but you also have to pay for your plant. In this case, remember you pay 30,000 for your plant asset. So that is a cash outflow. That's why it's a negative. So net cash from your investing is 5,000. And then dividend pay is 140,000. Retirement bond of bonds payable. So where do you pay that 150,000? It's not mentioned here. It could be mentioned somewhere else. Retirement. Let's say mortgage 70,000. Oh, here you see 2014 you have a bonds payable of 500,000, but then 2015 the balance is only 350,000. So you pay out, means that there's a difference there. It means that you pay out part of your bond payable. So you pay 150,000, so there's a cash outflow. So total cash outflow from financing is 290,000. So from 280 plus 5,000 minus 290, you have a net decrease of 5,000, right? So it means that cash, there's a decrease of cash by 5,000 from the opening to the closing. Well, how do you know that? You see that cash initially was 50,000, now closing is 45. So there's a decrease of 5,000 is reflected here, right? A net decrease in cash, and then you have cash opening balance, you have 50, closing you have 45. So this is actually 45,000 is represented in your financial position. But how do you know the movement from 50,000 to 45,000? So it shows here during the year what you pay for your active operating, what you pay out, or what you receive from your investing as well as your financing. So that is what a statement of cash flow tells you all about, right? So normally you are required to prepare the cash flow given the information like this, all right? One is the financial position, the other one is the additional information. Then from there, you prepare your cash flow. Okay. So this is what we call the indirect method. I will only show you the indirect method. And if I were to test you, I will test you on the indirect method. Right. So maybe here it says that decrease in account receivable. So again, all right, current asset and current liabilities. I'm not sure why the marketable securities is not there. Yeah, I think that should be part of the current asset. Okay, but later maybe you can check in the textbook. Here you have the account receivable, inventory, and your prepaid expenses, accounts payable, accrued expenses, and your non-operating losses. Right. So before we end, all right, let's look at managing cash flow. All right, it's very important for companies, right, not only to make sure that they have a profit, but they must also able to manage cash. Cash is very important. We say that cash is king, all right, because for business they need cash in order to cycle, all right, in order to pay for your accounts payable. So in order for you to have enough cash, in order for you to manage cash, all right, normally you will prepare a cash budget. All right, so when you prepare a cash budget, and either you prepare on an annual basis, you can also prepare your cash budget on a monthly basis. All right, then you should know, for example, your cash budget, you should know, okay, for example, if you prepare for a monthly basis, you should know that, okay, for next month, because when you say budget, you prepare before, right? So next month, you already know how much you have to pay, how much you are going to receive. So you're going to manage that cash, yeah? Why you can use cash budget, all right, to force management to coordinate activities. So when you prepare your cash budget, you will see that in the following month, how much is cash expected, right? How much is the forecast cash received and cash payment. If you based on the cash budget, you know that how much cash available is very minimal, then you have to do something about it lah. All right. For example, provide manager with advance notice of available resources. For example, that you know that, okay, next month I cannot have enough cash, so you either have to postpone the payment of your accounts payable, or you have to chase your accounts receivable. You have to chase your debtors to pay you so that you have the cash. And this cash you may have to use to pay for your accounts payable and other expenses. Right? And then the budget will also provide advance warnings of potential cash shortages. So you can see, right, the availability of your cash. You can budget, you can forecast. That's why you have to prepare the cash budget. So you know that, all right, for next month, you must know who is going to pay you, who you have to pay, right? Who's going to pay you is account receivable. Who you have to pay is your accounts payable and other liabilities. All right, so how can you manage your cash flow? How you have to increase your collection. So that's why for big companies, they have one unit that only look for collections. Yeah, collection means that they will chase the account receivable. All right, they give you the timing, 30 days, and then it goes to 60 days, 90 days. So you have to push your account receivable to make payment as soon as possible. So that's why a company, in order to reduce bad debt, for example, what they do, they give discounts to your account receivable, yeah. And then keep inventory low. Remember that for you to have for the inventory, in order for you to sell, in order for the inventory to convert into cash, the inventory must be sold first. If you sell the inventory cash, then you get cash immediately from your customer. But if the inventory you sell to your customer on account, it means that, all right, you will need some time for the account receivable to pay on the inventory. Yeah, so there will be a time lagging there. All right, for the accounts receivable to pay you back, all right, it will take higher. So that's why we say that keep inventory low, because inventory will hold up your cash. If you have a lot of inventory, it hold up the cash. So that's why some companies use what we call just-in-time method. All right, they will only order inventory when they have reached a certain level. All right, so that they don't have so much inventory unsold in their business. All right, another way is that to delay payment of liabilities. Yeah, so normally because remember, business has to play around with cash, so they have to collect from account receivable as soon as possible. And if they can postpone the payment to their liability, to their payables, all right, any payment of liabilities, if they can delay, they will have to delay that. All right, so because they want to play around with the cash flow. All right, and then plan timing of your major expenditures, especially if you want to, for example, we want to purchase, acquire an asset. All right, even though most of the company will rather than pay cash, all right, they will have to pay on account. But normally you have to pay some deposits. All right, so that deposit need cash, so you have to plan, right, when is the best time for you to incur major expenditure. And other companies may have a lot of cash. All right, idle cash means that they are cash king, right? So it's good thing that if the company have a lot of cash, right, idle cash, so the cash can be invested somewhere else, all right, and then can gain interest income, for example, all right, or you may invest in shares and then you get a dividend. But remember that you must be able to decide whether how much can you invest the idle cash, right? Because sometimes you have certain amount of money that you're going to use that in few months time. So during that period, you may want to invest and make sure that during the time that you have to pay, all right, you must be able to retrieve your investment. All right, means that you may be able to sell back your investment to get your cash. All right, so this is the one that we have done adjustment just now. All right, all right, and then okay, that's covered for your topic on cash flow, right? So later we'll do one tutorial question, for example, maybe. All right, maybe we can do I'll do a adjustment for, I'll do one tutorial for that. Right, so with that, I think that's all for today on the cash flow, right? Please watch the video again, and you can chat with me if you have any issues. Thank you.